history on American Heartland. We've been specializing in concentrated animal feeding operations across the Midwest since 1981. We are currently active in about 15 different states, from North Dakota down to Texas, Colorado, Wyoming, over to Ohio. We represent A-rated carriers, and we have offices in Iowa and Nebraska. What I'm going to do is start off talking about property coverage. I'm going to go through blanket coverage, the definition of that, what coinsurance is, describe the differences in the causes of loss, basic, broad, and special, go over replacement cost coverage versus actual cash value, and inflation guard. Blanket coverage will lump property values together so you have the total amount for any one loss. Some companies will blanket by each individual insured locations. Others will blanket all locations together. In this next slide, I kind of have some examples. In these three examples, the insured has 4 barns insured at $600,000 apiece, 2 barns at location 1 and 2 barns at location 2. If there was a total loss to one of the buildings at location 1, this is how the policies would respond. With no blanket coverage, you have the limit of the $600,000 for that barn. Blanket by location, you'd have up to the total limit of that location, which would be $1.2 million. Blanket all locations, it lumps all the buildings together, so you have the total limit of the $2.4 million. Next thing we're going to talk about is coinsurance. Most building and business personal property policies have a coinsurance clause, which requires the insured to carry insurance equal to at least a specified percentage of the replacement cost value of the property. If a loss occurs and it is determined that the amount of insurance carried is less than the amount required, a penalty could be placed on the insured. This next slide will give you a couple different examples of how that actually works. The replacement cost of a barn is $500,000. If the policy has an 80% coinsurance clause, the building needs to be insured for at least $400,000 to avoid a coinsurance penalty. On example 2, the replacement cost of the barn is $1 million. The policy is written on a 100% coinsurance, but the building is only insured for $900,000. In this situation, the insured would get hit with a coinsurance on the $100,000 that they're underinsured. So it's really important to know what kind of coinsurance you have on your policy, and to make sure your policy is, or your buildings are insured up to replacement cost values. Next, we get into the different kinds of causes of loss. Basic cause of loss is just going to give you coverage for a list of perils. The list of perils are fire, lightning, windstorm, hail, explosion, vandalism, smoke, sprinkler leakage, aircraft or vehicle damage, riot or civil commotion, sinkhole collapse, and volcanic action. That's going to be your basic perils. Broad cause of loss forms are going to give you coverage for a few additional perils. Your largest one is going to be collapse due to weight of ice, snow, or sleet. Breakage of glass, water damage, and falling objects are also included. Special cause of loss is the broadest of them all. It is best known as all risk coverage. It'll cover pretty much all risks except for those that are specifically excluded. Some of the excluded perils would be earthquake and flood are going to be your 2 largest perils that are excluded under special cause of loss. It is possible too for a commercial policy to have more than one cause of loss forms on there. When we write the confinement buildings, we'll usually write those on the special cause of loss form, and the livestock is usually written on a broad cause of loss form, limiting the coverage on them. The next slide here is a replacement cost and actual cash value. Property can be valued in several different ways. Insurance companies commonly use 2 approaches to determine the value. which also determines how a loss will be paid, the replacement cost method, and the actual cash value method. Replacement cost, of a property item to be the cost to replace it with like kind. Actual cash value is replacement cost minus the accumulated depreciation for age and condition. And here's another slide just showing two different examples of how a policy would respond for both actual cash value and replacement cost. In this example, say your building's 15 years old, the windstorm comes through and does $100,000 damage to the roof. The life expectancy of a hog barn roof is roughly 30 years. Your policy has a $5,000 deductible, and this is how it would respond. With replacement cost, the company would replace your roof minus your deductible. But actual cash value, what they're going to do is they're going to depreciate your roof out. Since half the life expectancy of your roof is used up, the company would depreciate your roof by roughly 50% minus your deductible also, and it'd pay out $45,000. And different companies determine that differently. They have different formulas and calculations to determine the depreciated value, so it's not really cut and dry like that, but that's a pretty good example of how replacement cost works and how actual cash value works. The next slide here is inflation guard. An insured can insure a building for its full value at the beginning of the policy year, but by the end of that year it might not be covered for its full value. This problem can be corrected by adding an inflation guard onto the policy, which will automatically increase the value of the value of the buildings by a certain percentage. With us, we usually do about a 3% replacement cost, or 3% inflation guard on there. Liability coverage. Going to go over occurrence form versus claims made form. General aggregate / occurrence limit. Products and completed operations. Medical payments. Pollution liability endorsement. CCC endorsement. And umbrella. The occurrence and claims made policies. A policy is usually written on two main forms, occurrence and a claims made form. For a claim to be covered under an occurrence form, that claim needed to take place during the policy period. For a claim to be covered under a claims made form, that claim needed to take place and be turned in under that policy period. So I have a couple different examples of how both of those work. The claim example would be 2 years ago someone was out visiting the site and slipped and fell. They didn't appear to be injured, so no claim was turned into your insurance carrier. A couple of years later, you start to receive medical bills stating that you are responsible for the injury that took place at your premise. This is how the two different policies would respond. With an occurrence policy, in this particular example, the claim would be covered under the occurrence policy since it happened during the policy period. The claim does not need to be turned in during that policy period. But a claims made, the claim would be denied basically because even though it happened during the policy period, it was not turned in during that policy period. The general aggregate versus occurrence limit. Your general aggregate limit is a total amount the company will pay out during the policy period, where the occurrence limit is a total amount the company will pay out for any one individual claim during that same policy period. Products and completed operations coverage. Products coverage is provided for damages arising out of products manufactured, sold, handled, or distributed by the insured. Completed operations covers damages occurring after operations have been completed or abandoned, or after an item is installed or built and released for its intended purpose. Medical payments coverage pays medical expenses resulting from bodily injury caused by an accident on premise, owned or rented by the insured, or locations next to such property, or when caused by the insured's operations. These payments are made without regard to the liability of the insured. Another coverage that we offer is a pollution liability endorsement. This endorsement redefines animal waste, and it is not considered a pollutant under our policy. Currently, we have a hold on that coverage in the state of Missouri due to several nuisance lawsuits that are taking place right now. Hopefully we'll be able to open it up soon, but as of now we aren't able to offer that in the state of Missouri. The next one is a care, custody, and control endorsement. This endorsement removes the care, custody, and control exclusion under your liability policy. It provides defense coverage in the event of a lawsuit claiming negligence, which results in the death or destruction of livestock in your care, custody, or control. This coverage is written on a named peril basis with a policy limit of $1 million. If you're custom feeding for someone, there's a good chance that in your contract with them that there is that you are responsible for the livestock if something were to happen out of your negligence. This endorsement is able to pick up the coverage for you, up to $1 million under the general liability. It's a very reasonably priced coverage. I think it's 12 cents a pig space a year for a $1,000 deductible. So, the umbrella coverage provides an additional liability coverage over your underlying auto liability and employer's liability. It's usually written in dollar increments, $1 million increments up to $5 million. We will not write in excess for our pollution liability endorsement. All right. The next one is some optional coverages and endorsements that we offer. Farm employer's liability versus workers' compensation, builder's risk, earthquake, flood, terrorism, business income, extra expense, livestock transit, business income, utility service interruption, parents damage waiver, and mechanical and electrical breakdown. Farm employer's liability provides minimal coverage for injured employees, where workers' compensation is more broad than farm employer's liability. It will provide cash benefits and medical care if an employee becomes disabled because of an injury or illness related to the job. The builder's risk endorsement provides coverage for the structure while they are under construction. This endorsement will also pick up coverage for theft of building material. Earthquake coverage extends your cause of loss to include damage that results directly from an earthquake. Coverage is provided for replacement of building only. All earthquake shocks that occur within 160 hours or 1 week are considered to be a single occurrence. A separate deductible applies. It's usually a percentage of the building values. Flood insurance is covered under a completely separate policy that is underwritten by the federal government. In this line of business, you really don't see too many flood policies because everything's built out of a floodplain. So, next is terrorism coverage. It provides coverage for a certified act of terrorism. A lot of people get this confused with vandals. PETA and those type of groups, the domestic terrorists, aren't considered actual terrorists, they're considered vandals. So you'd have coverage under your basic form for any acts that they commit. To be constituted an act of terrorism, it has to be a loss in excess of $5 million, and it has to be committed by a foreign national or on behalf of a foreign national. I'd say 99.9% of people decline the coverage, which I'm not going to talk anybody out of coverage, but that's one that, yeah, it's tough to justify. Business income and extra expense. Business income pays for the actual loss of business sustained by the insured because of a necessary suspension of the insured's operation during the period of restoration following a loss. If you're a custom grower, it'd basically be your loss of rents. So the amount of time that you're down, say you're down for 6 months while you're rebuilding from a fire, we'd pay your loss of rents during that time. Livestock transit. If you do own the livestock, we can offer livestock transit. It's kind of a neat coverage. What it does is The actual peril that it's insuring against is transit. So anything that happens to the livestock while they're in transit, there's coverage for. We've had situations where semi's going down the road and it breaks down, 100-degree weather, and all the pigs in there basically suffocate because of the heat. There's coverage for that under this policy. Business income, service interruption provides business income and extra expense coverage due to utility service interruption. New coverage they're coming out with. A lot of the commercial companies are coming out with this also. It's an appearance damage waiver. What it does is it changes the policy wording to state that coverage does not apply to appearance or cosmetic loss or damage to metal roofing caused by or resulting from windstorm or hail. A lot of companies are coming out with that and requiring that you have it. What we do is we offer a 10% credit if you add that to your policy. Instead of requiring it, we'll actually give you a credit for having it on there. Mechanical and electrical breakdown is the next one. All that does is add the 3 following perils onto your policy. Mechanical breakdown, electrical arcing, and steam explosion.